Keeping an eye on Wall Street. Financial market update. Market index, Standard & Poor's 500 index for June 19, 2009, $921.23, as compared to June 19, 2008, $1,342.83, a drop of 31.4%. Dow Jones Industrial for June 19, 2009, $8,539.73, compared to June 19th of 2008, $12,063.09, a drop of 29.2%. The recent stock market rally has inspired a rising tide of hope and optimism within the investor community. Evidence of this is seen in the gentle step-up in market values from the floor of their recent decline. This optimism seems to be discounted into the price-to-earnings ratio of the S&P 500 index as well, since the current price of $921.23 represents a price-to-earnings ratio of 31.2 times the next 4 quarters of forecasted earnings per share for the index. Since the historical valuation for this index is significantly below the current level, it stands to reason that the investor community collectively believes that the government initiatives will create a market recovery in the near term. At the Financial Freedom Report, we are not yet convinced that the fundamentals of the market justify such an optimistic valuation. On the money, monetary update, comparing the money supply in billions of dollars for May of 2009 to May of 2008. The monetary base for May of 2009, $1,770 billion, compared to May of 2008 of $827 billion. That's an increase of 114%. M0 plus checking, M1, for May of 2009, $1,596 billion, compared to May of 2008, $1,373 billion, an increase of 16.2%. M1 plus savings, M2, for May of 2009, $8,327 billion, compared to May of 2008, $7,637 billion, an increase of 9%. Analysis of the key monetary indexes shows that the current Federal Reserve policy of hyper-increasing the money supply is still in effect. The desired result of this policy is to stem the current asset price declines from large amounts of selling and deleveraging from credit tightening. The implicit danger is that when the credit markets eventually normalize, it will create a massive net increase of circulating dollars chasing after a static or declining mix of products and services. Traditional monetary theory predicts that when there is a sharp increase in the net effective money supply without a corresponding increase in output, then the result must be price inflation, more dollars chasing fewer goods. At the Financial Freedom Report, we are convinced that this inflation is looming on the horizon and will hit many people by surprise by destroying their savings, stocks, bonds, mutual funds, equity and real estate, and, thankfully, the value of their debt. So the key strategy we recommend is to denominate perceived liabilities in dollars and assets in things that have universal need.
Best investment during financial Armageddon? If you were to sit down with a very large book of matches, an inexhaustible supply of meals ready to eat, and burn up $1 million every day, it would take you 3,000 years to turn $1 trillion into ashes. So, $1 trillion is a whole bunch, right? But are the trillions of dollars the federal government is racking up in debt going to send the United States into financial Armageddon? Well, that's a pretty strong word. We don't think it's likely there will be a complete collapse of society, but it could get hairy for a while. And at the end of each day, every human must still meet 3 basic needs: food, clothing, and shelter. Did we say shelter? Yes, we did. As a property investor, you will control the asset everyone needs. They still need a place to sleep and are going to have to rent it from someone. Why not you? Housing is a universal need that's not going anywhere. Welcome to the Platinum Properties Investor Network, the source for innovative, forward-thinking investment property strategies and advice. Founder Jason Hartman spent 2 decades developing the complete solution for real estate investors. Jason appears regularly on television and radio, at speaking engagements, seminars, and with his ultra-hot Creating Wealth podcast.